Hello and welcome to Yadnya Investment Academy. Today we are going to review and compare top liquid funds. Liquid funds is one of the most popular debt fund category where you should invest your money for investment horizon of less than 6 months. This category is used as an alternate to your savings account balance, as this category is lowest risk mutual fund category. Most of the investors use liquid funds to park their emergency funds or for their ad hoc near-term expenses. Let me first explain the methodology of the review. We will list, review and compare funds on various parameters and rate them by giving green, yellow and red star. Green star means good performance, yellow means average and red means below average performance. In the end, based on total number of green, yellow and red star, you can take a call to buy this fund or not. Before we start the review, we want to inform you that we have come up with our first book which is on mutual funds and SIP. Book is available on Amazon, Flipkart and other channels. Link is mentioned in the description of this video. Please remember all the fund parameters we are going to discuss here are based on 24th November 2017 data as reference, and we only review regular and growth plans of mutual funds. These are the 7 funds we will review and compare today. All of these funds are from top 10 mutual fund houses in India and have a very healthy asset under management of more than 15,000 crore rupees and have been active for more than 7 years. So have seen at least one complete interest rate cycle. So on these factors, we give all these funds a green star. Now let's talk about their return performances. All the funds have CRISIL Liquid Index as the benchmark, but since CRISIL doesn't share the information of this benchmark, we will compare the fund's performance with their category average as defined by Value Research. Since liquid funds is the least risky mutual fund category, hence we expect very low volatility in return performances, and that's how it is. This table shows trailing return performances of these funds, and this one shows calendarized returns of the fund. That means returns from 1st Jan to 31st December of a calendar year. There is very less difference among funds in terms of returns. Maximum return was given by Axis in last 1 year, that is 6.72%, and minimum was given by HDFC, that is 6.54%, which is less than 0.2% difference, which is very low. In calendar year returns as well, we see very less difference among all the funds. Figures in yellow are best returns in that calendar year and blue are the worst. We can see, especially in last 5 years, difference between best and worst is less than 0.2%, which shows how closely liquid funds performs. Liquid fund performs very close to short-term fixed deposit rates, and that's what we can see in the calendar returns over the years. Now if we compare all these funds with the category average, we see they all performed above category average consistently, and hence on this parameter we give all the funds a green star. Now let's talk about the interest rate risks these funds are taking. Modified duration reflects the interest rate risk, and higher its value, more the risk. For example, 0.11 years modified duration here means fund value will change 0.11% only with 1% change in interest rates. To know about modified duration in detail, you can check our video on this topic. YTM here reflects the probable returns this portfolio can give if held till maturity, which is this value. So higher the YTM, more returns you are likely to get. As expected, liquid funds modified duration is very low, which means they take very low risk. Also, in most of the cases, average maturity is same as modified duration, which means all of them invest in zero coupon debt instruments only. Now from relative terms, Reliance liquid fund is taking higher interest rate risk and SBI fund is taking the lowest. From YTM perspective, SBI's fund has capability to give you maximum return, whereas HDFC one has the lowest. Now difference among all is so low, therefore it is difficult to give them stars, but still comparing with category average, SBI fund should be given green star for lower risk and higher return expectation than category, whereas HDFC fund deserves red star for higher risk and lower YTM. Rest all can be given yellow stars for being near average. Now let's talk about credit risk. Credit risk means risk of default by companies these funds have invested in. You can tell the amount of credit risk by seeing the credit rating of the securities these funds have invested in. These credit ratings are done by renowned rating organizations such as CRISIL and CARE, etc. Now, liquid fund category is known for taking lowest credit risk, as most of the investors in this category invest here to park funds for very short term rather than aiming for higher returns by investing in risky assets. As expected, almost 100% of funds are invested in sovereign or AAA rated papers only, and hence all of them can be given a green star. Now the last parameter for review is the cost of holding these funds. Probably the most important factor for selecting the fund in this category. DSP Blackrock liquidity plans expense ratio is definitely on higher side, and this could be the reason why 5 out of 10 calendar years returns this fund's performance was lowest among its competitors discussed here. Even though difference was small, but that is all the margin in liquid fund category. For this we give a red star to this fund. Axis, SBI and ICICI have a good expense ratio in comparison to category and deserves green star. Rest 2 are close to category and should be given yellow star. None of the fund has any exit loads. So this is the summary of their ratings on all the parameters we discussed. You can choose the fund based on the parameter which is most important to you. We can clearly see all through the video, all these funds have very low difference in terms of performance or risk taking, and hence we would suggest you to choose any one of the listed here. In order to earn maximum benefit of liquid fund, it is more important how fast and how much money you transfer to liquid funds after your salary gets credited. That extra 1 day or extra 1000 makes all the difference in returns rather than the type of fund in this category. That is all we have on this topic. If you have any question, please do write in the comment section below, and do not forget to subscribe to our channel for more such videos. Have a great time ahead. Jai Hind.